The rise of ETFs, or exchange traded funds, if you didn't know that before, has grown in popularity due to investors seeking high yields and stable returns. As with stocks and many mutual funds, most ETFs pay their dividends quarterly. However, ETFs that offer monthly dividend returns are also available in the market. While there are many ETFs that pay out regular dividends, we look at just 8 of them here in this video. Just note, depending on when you watch this video, the numbers may be different from when I made this video, so just keep that in mind. Hey, what's up guys? My name is Eamon, and if you haven't joined us before, I talk about personal finance tips and how to grow your wealth. So if you guys can hit that like and subscribe button, YouTube will think we're kind of cool and push this video out a little bit more. One of the main advantages of monthly dividends is that they can be used to manage cash flows and budgeting for a predictable income stream. These types of products can provide a higher total return since it's on a more recurring basis. These 8 monthly paying dividend ETFs that I'll talk about in this video have strong dividend policies and have reported strong financials in the first quarter of 2022. All right, so let's get right into it. Here are my 8 dividend ETFs that will pay you monthly in 2022. Flying in at number 1, we have a WisdomTree US High Dividend Fund, or DHS. Here's some quick facts. Net assets are $1.2 billion. The expense ratio is 0.38%, which means you'll be paying $38 for every $10,000 you invest, and the dividend yield is 3.15%. The fund's holdings are pretty well diversified across sectors such as IT, utilities, healthcare, and consumer staples. Some top holdings include Verizon Communications, AT&T, Pfizer, Philip Morris, and the Coca-Cola Company. Investors with a longer-term horizon should consider the importance of large cap value stocks and the benefits that they can provide to any well-balanced portfolio. This sector is typically regarded as one of the safest in the world, and it tends to be in stable industries. The index DHS is linked to has around 330 holdings, and although the fund has a large number of securities, it is still heavily exposed to the top 10 companies. DHS provides investors with exposure to companies that pay attractive dividends. This makes it an ideal pick for long-term investors who are looking for a steady income stream along with a lower expense ratio. All right, at number 2, we have Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD. I have no idea who makes these names. So here's some quick facts. Net assets as of mid-2022 are $4 billion. Expense ratio is 0.3%, so you'll be paying $30 for every $10,000 you invest. And the 12-month dividend yield is 3.53%. The fund is well concentrated in consumer defense and utilities, and their holdings include Iron Mountain, Altria Group, ExxonMobil, Vornado, and AT&T. As the name suggests, SPHD aims to give you, the investors, with highest dividend yield and lowest volatility. It does this by selecting the companies from the S&P 500 that pay the highest dividends while maintaining the lowest volatility. SPHD tends to be concentrated in utility and defense stocks, while it is light on tech companies. To prevent a single sector from taking over the portfolio, the fund has a set of rules that limit holdings to 10 stocks per sector. SPHD is a reasonable alternative for investors looking for a steady stream of income and a lower volatility. All right, at number 3, we have Invesco Preferred ETF, or PGX. Here are some quick facts. Net assets as of mid-2022 are $5.8 billion. Expense ratio is 0.51%, so you'll be paying $51 for every $10,000 you invest. And the 12-month dividend yield is 5.44%. The bulk of investments is in BBB-rated holdings. Some of the holdings include Citigroup Inc., JP Morgan Chase, Wells Fargo, AT&T, and Bank of America Corp. This ETF exposes investors to preferred stocks, which is relatively unknown to the capital market segment. Preferred stockholders have a preferred position on assets compared to other common shareholders should there be a liquidity event in the company. These shareholders typically do not have voting rights, and preferred stock is a type of investment that provides investors with a steady stream of income and does not participate in equity appreciation that common shares offer. This type of preferred stock is ideal for those who are looking for a higher yield and are looking for less risky alternatives to broad portfolio stocks. PGX is a little short on diversification as it only holds around 80 securities, and most of them are in the financial industry. But this ETF is a great tool for investors if used properly, but just be mindful not to invest more than you should in the sector. All right, coming in at number 4, we have Global X Super Dividend US ETF or DIV. Net assets as of mid-2022 are $788 million. Expense ratio is 0.59%, so you'll be paying $59 for every $10,000 invested, and the 12-month dividend yield is 12.89%. Some of the main holdings of the fund are Yanzhou Coal Mining Company, Fortescue Metals, Electric Consumer Products, Omega Healthcare, and Iron Mountain Inc. The goal of the Global X Super Dividend Fund is to provide investors with a high level of exposure to companies that pay a high level of dividends. It does this by tracking an index that is composed of the top 100 dividend-paying companies in the whole world. This fund seeks to provide high-quality dividend income and lower than average volatility by investing in various types of real estate investment trusts and master limited partnerships. It has been making monthly distributions for over 9 years now. Okay, at number 5, we have iShares Preferred Income Securities ETF or PFF. Net assets as of mid-2022 are $16.1 billion. The expense ratio is 0.45%, so you'll be paying $45 for every $10,000 you invest, and the 12-month dividend yield is 5.61%. Some of its main holdings include Broadcom Inc., Bank of America, NextEra Energy, and Avantar Inc. This type of fund, just like PGX, provides exposure to preferred stocks which are relatively unknown in the capital market segment. Just to reiterate what I was saying before, preferred stockholders have a preferred position in the company, which means that they have the upper hand if there were to be a liquidity event. PFF is fairly diversified across financial and non-financial sectors. The fund has just under 250 securities and is heavily weighted towards the financial industry, although other sectors do comprise nearly 20% of the fund as well. This type of fund should only be used in small amounts to boost its yields. Although PFF is a great tool for investors, it should not be used as a go all-in investment. All right, at number 6, we have Amplify CWP Enhanced Dividend Income ETF or DIVO. Here are some quick facts. Net assets as of mid-2022 are $1.74 billion. Expense ratio is 0.55%, so you'll be spending $55 for every $10,000 you invest, and a 12-month dividend yield of 5.19%. DIVO is relatively well balanced among the traditional 10 S&P sectors, which include United Healthcare, Chevron Group, Home Depot, Johnson & Johnson, and McDonald's Corp. So why is DIVO such a great pick? It has pretty good income potential since it's comprised of high-quality dividend-oriented stocks, along with covered calls on individual stocks, and is an actively managed fund. So this allows the portfolio manager to identify opportunities and risks and act on those decisions in real time. It also seeks to lower volatility. Dividend and option income may provide a lower share price volatility versus the overall market during times of broad-based market declines. DIVO is managed with a strong emphasis on owning high-quality, large-cap companies with historical dividend and earnings growth. All in all, I believe that this is a great pick. Okay, at number 7, we have Invesco KBW High Dividend Yield Financial ETF or KBWD. Here are some quick facts. Net assets as of mid-2022 are $449 million. Expense ratio is 2.59%, which means you'll be paying $259 for every $10,000 you invest, and the 12-month dividend yield is 8.81%. Some of the holdings include Orchid Island Capital Group, Chimera Investment Group, Armor Residential, and AGNC Investment Trust. KBW is a little different, but in a good way, in that it allows investors to access attractive dividend yields from various financial institutions such as banks. However, it's also a risky bet as the underlying companies are typically a little less stable and could have better financial footing. I wouldn't recommend KBWD for individuals with low tolerance for risk. The hyper-targeted nature of this fund also decreases the appeal of this type of investment to those who are planning on building a balanced portfolio. However, for those who are looking to enhance the current return generated from the equity side of their portfolio and lean towards dividend-paying stocks, KBWD is a great choice. Last but not least, we have number 8, which is JP Morgan Premium Income ETF or JEPI, which is my personal favorite so I might talk about it a little more than the others. Here are some quick facts. Net assets as of mid-2022 are $9.83 billion. Expense ratio is 0.35%, so you'll be paying $35 for every $10,000 you invest. And the 12-month dividend yield is 10.93%. JEPI is an ETF that was first introduced in May of 2020 by JP Morgan. So it's relatively a new product on the market, but it's actually been around for a long time in mutual fund form. The goal of this fund is to provide current income while also leaving room for capital appreciation. Unlike other types of exchange traded funds, JEPI is an actively managed product. It has a team of portfolio managers that are responsible for implementing the strategy that they set forward and run the fund. The strategy of JEPI is divided into two separate segments, which are income and growth. So let's talk about the growth a little bit. For growth, the fund managers of JEPI hand select a basket of stocks from the S&P 500. They're buying stocks that they determine are undervalued based upon a fundamental analysis at their current prices. And with the stocks that they're picking for their ETF, the aim is to capture a majority, not all, but the majority of the S&P 500 index, while also limiting the downside risks. So essentially, those two fund managers are picking from a selection of stocks from the S&P 500 that they think will deliver most of the same growth of the index, yet are a little bit safer than average and won't fall as hard as the rest of the index. And so for the next segment of the JEPI strategy is income. And that's the reason why we're all here, that flashy 10 to 11% dividend yield. How do they make that happen? So to create the income that JEPI gives off, the fund invests up to 20% of its overall holdings into ELNs or equity linked notes. If you don't know what ELNs are, basically without going too deep into it, they're debt instruments that allow a borrower to raise funds by promising to repay a lender within a certain time frame agreed by a contract. If you're someone looking for current income, you want your investments to be giving you as large of a paycheck as possible today. You're not necessarily concerned with building as large of a portfolio as humanly possible within 20 to 25 years, then JEPI should be a strong consideration for you. From all the research that I've done and everything that I've looked into, JEPI seems like a really solid investment and a really solid choice. You wouldn't be making a huge mistake by adding it to your portfolio. All right, guys, so those are my top 8 picks for monthly paying dividend ETFs. If you guys enjoyed this video, please hit that thumbs up button and hit that subscribe button. And I want you guys to comment down below what dividend ETF you guys are invested in today. All right, guys, I will see you guys in the next video. Peace.